Everyone thinks they understand Marathon Digital. They don't. They still believe it's just another Bitcoin miner, a speculative bet that moves up when Bitcoin runs and collapses when it doesn't. Wall Street treats it like a volatility trade. Retail treats it like a meme. But here's the problem. They're using the wrong playbook. They're analyzing Marathon Digital like it's stuck in 2021, like nothing's changed. Meanwhile, the business has evolved so far, so fast that most investors are pricing in a ghost that doesn't exist anymore. So the real question is this: what happens when a misunderstood company starts printing real profit, building infrastructure nobody else sees, and locking in partnerships nobody's talking about? You get mispriced execution. You get margin the market ignores. You get a stock that nobody respects right before it punches Wall Street in the face. And Marathon Digital, it just did that. So let's unpack what they actually built. Not the hype, not the headlines, the numbers, the strategy, the trap Wall Street just walked into. So let me save you the trouble. If you're analyzing Marathon Digital like a Bitcoin proxy, you've already missed it. This isn't a miner anymore. This is a vertically integrated infrastructure company that prints Bitcoin the same way data centers push packets, efficiently, quietly, and at scale. They don't rent space. They don't lease power. They own it. 70% of their operations are now fully controlled, powered by their own energy, running on their own land, producing assets they didn't buy, they built. Let that sink in. Most companies are still figuring out how to scale into the AI cycle. Marathon Digital already controls 1.1 gigawatts of energized capacity, and they've got up to 1.7 gigawatts ready to go. You know how rare that is? That's not mining, that's compute on demand. And here's what almost nobody gets on Wall Street. When you control compute and power, you don't just win the margin game. You control the future of infrastructure, especially in a world where AI, crypto, and data centers are all crashing into the same energy wall. So no, this isn't a speculative Bitcoin flyer anymore. Marathon Digital is now an infrastructure operator hiding in plain sight. And the market's still pricing it like it's 2021. That disconnect is where the opportunity lives. Let me show you the part of Marathon Digital's business everyone underestimates: their balance sheet. They're sitting on 49,951 Bitcoin, worth over $5.3 billion. But here's what matters. They didn't buy that with debt. They earned it, mined it, produced it through operations, not financial engineering. So while MicroStrategy is mortgaging the future to stack Bitcoin, Marathon Digital is stacking through execution. That's a different game, and it comes with leverage that doesn't show up in a traditional DCF model. And here's the part most analysts still miss. 31% of that Bitcoin is deployed, loaned, and collateralized, or actively managed to generate real yield. They're not just holding Bitcoin, they're using it to reduce the cost of capital, fund growth, and build optionality. That's how they posted a $1.2 billion gain on digital assets while still having dry powder left to deploy. This is a Treasury strategy with teeth. It's not passive, it's productive. And because their cost to mine each Bitcoin is just $33,735, they're compounding value at one of the lowest unit economics in the entire crypto sector. They're basically producing money at wholesale rates and then reinvesting that capital into infrastructure the market hasn't priced in yet. So while everyone else is watching Marathon Digital like it's a ticker that follows Bitcoin, the real alpha is in what they do with the Bitcoin after it hits the wallet. They don't flip it, they weaponize it. Now let's talk about the elephant in the room. Marathon Digital is down 3.49% year to date and 18.78% over the last 12 months. And on the surface, that looks like a red flag. But here's what I see and why I'm not panicking. The business is breaking records in profitability, energy control, and hash power. They're sitting on $5.4 billion in liquid assets, posting a beta growth over 1,000%, and they've built one of the most misunderstood infrastructure plays on the market. So what gives? Simple. Wall Street is using the wrong model. They're still pricing Marathon Digital like a leveraged Bitcoin miner, not as a vertically integrated energy operator that mines digital assets with full stack control. They're looking backward. They see Marathon Digital as a proxy for Bitcoin, which means they're missing the fact that this business is now built to survive Bitcoin winners and scale into compute demand booms. The chart is lagging because the narrative hasn't caught up to the transformation. But when that gap closes, and it always does, the move is fast. You're either early and in, or you're chasing it later at a higher price. And I've seen this before. The second a stock goes red, the haters and Karens flood the comments like clockwork. They tell me I'm clueless. They call it dead money. They say I told you so. But while they're ranting, I've been running the wheel strategy on Marathon Digital since February of 2024, and I'm up over 36%. That's not a projection, that's my real return. The stock's down, I'm up. That's what strategy looks like when you stop guessing and start executing. Most investors get scared when a stock's red. We've got strategies to profit while we wait for the market to catch up. That's exactly the kind of edge I walk through inside my Patreon, and it works. So let me say this clearly. You don't wait for the chart to look good when the business is already great, because the market isn't going to give you both. Everyone's talking about GPUs, data centers, and compute, but almost nobody's connecting the dots back to Marathon Digital, and that's the gap. While the market is chasing semiconductors and server racks, Marathon Digital is sitting on 1.1 gigawatts of energized capacity with expansion potential up to 1.7 gigawatts. You know who needs that kind of power? Not Bitcoin miners, not retail traders. AI infrastructure providers. And Marathon Digital just stepped into that world with its first fully owned and operated high-performance computing data center. It's a 2.7 megawatt facility in Granbury, Texas. It's already running AI workloads behind the meter using their own renewable energy. That's not a test, that's a wedge. Because here's the reality. AI isn't constrained by models anymore, it's constrained by power. And Marathon Digital doesn't just own the rigs, they own the energy. They control the flow. That gives them leverage nobody sees coming. Think about what happens when you pair on-site generation, data center control, and already profitable mining operations, and then begin to allocate that infrastructure to AI workloads. That's not pivoting away from Bitcoin. That's stacking two exponential demand curves on top of the same physical footprint. And right now, Wall Street hasn't priced in that optionality at all. They're still valuing Marathon Digital as a commodity miner. But the second that AI revenue starts flowing through those facilities, it changes everything. This is the most mispriced wedge in the AI infrastructure cycle, and Marathon Digital already owns the land. So let's cut through the noise. This isn't about liking Bitcoin or betting on tech. This is about whether Marathon Digital as a business is getting stronger every quarter, becoming harder to compete with, and printing cash while Wall Street mislabels it. Let's start with the bull case. Marathon Digital controls power, property, and production. It owns over $5 billion in digital assets and is generating positive cash flow. EBITDA just exploded over 1,000%. Their AI data center is already live, running workloads behind the meter on infrastructure they own. This isn't hopium, it's execution. And now the bear case. The chart still looks bad. Bitcoin is up over 25% this year and nearly 70% over the last 12 months. But Marathon Digital hasn't followed. That disconnect isn't just annoying, it's the exact kind of setup that can wreck emotional investors. Add in capital demands and you've got a business that needs time and positioning, not hype. So where does that leave us? This is a business I believe in. My thesis on Marathon Digital remains bullish, but you have to know how to play it. The company is executing, the numbers are improving, but Wall Street hasn't caught up, and the price hasn't reflected the shift. That's where most retail investors lose money. Because being early doesn't mean anything if you don't know how to manage the position. This kind of opportunity rewards discipline and punishes hope. If you're in without a strategy, you're gambling. But if you're in with a plan, this setup still has room to run. What I'm doing right now, let me be clear, I'm not guessing, I'm not hoping. I've been running the wheel strategy on Marathon Digital since February of 2024, and I'm up over 36% while the stock is red. That's not a fluke. That's how knowing the right strategy can make you money while everyone else is losing. And until Wall Street catches up to what Marathon Digital has actually built, the data centers, the Bitcoin Treasury, the energy leverage, the HPC wedge, I'm going to keep running it. Because here's the real question. Is this business getting stronger every quarter? Yes. Are the numbers trending up across production, cash flow, and capacity? Yes. Is the product becoming harder to compete with? Absolutely. That's what I bet on. Not the daily chart, not the noise, the fundamentals and the trend underneath the price. This is still a buying window, but not for everyone. If you don't have a strategy, if you don't understand how to manage premium, protect downside, and build into strength, then yes, this stock will chew you up and spit you out with a loss. But if you do know how to structure the position, then Marathon Digital is one of the most overlooked assets and can be a cash machine. I'm not just holding, I'm actively managing it. This stock stays in my portfolio, and I'm looking to build more size when the bullish trend kicks in. Because the stock price might still be wrong, but the business isn't. So let me ask you something. Who else is breaking down Marathon Digital's real business model, the misunderstood energy leverage, the $5.4 billion in assets, the AI expansion nobody's pricing in, and actually showing you how to profit from it in real time? Who else gives you the bull and bear case, shows you the thesis, and walks you through how to act with conviction? Nobody. That's why Marathon Digital is one of the names I've been trading all year. And while most people are still guessing, I've already locked in over $1.826 million in profits year to date. I'm up 52.3% in 2025, and it's not just me. Richard closed out last week with over $2,000 in profits across NVIDIA, Google, and Marathon Digital before the dip. Wreaks Havoc pulled in $753 off a single OKTA trade, and Jack cleared $1,492 on Robinhood and said it best: Hood's printing cash, and it's still a buy. This isn't hype, this is execution. Inside my Patreon, you get real-time trade alerts with the full breakdown, what I'm buying, when I'm selling, and why, daily market insights that cut through noise and point to setups that actually work, and the same systems I use to build seven-figure positions with real discipline. It's just $30 a month. People blow that on DoorDash without thinking. This is one thing that could actually pay you back. You want to know if it works? That's why my accounts are up over 52% this year. This isn't theory. This is what consistent real-world execution looks like. Try it. If it doesn't sharpen your strategy, grow your account, and give you more confidence in every trade, cancel anytime. No pitch, no pressure. But if you've been watching this channel, nodding along, and telling yourself I should join, then it's time. Stop watching, start building, because the truth is simple. You can scroll or you can scale, but either way, don't say you weren't told.